Hey everybody, Mitch Wilder here with the Ahead of the Curve podcast. And of course, I've got my co-host here with me, Micah Frame. And as in many of our episodes, a lot of you may be wondering, am I paying too much in taxes, right? You want to know if your tax plan is sound. And along with that, you may be asking the question, how much should I be paying myself in my business? So in today's video, Micah is going to share a couple strategies and a few examples for tax planning purposes and for example purposes to see how to set your optimal salary. So Micah, since we're getting into some details, I know you've got some disclaimers on this one that you want to add. So I'm going to let you take it away and add those disclaimers.
Yeah. So first I'll start with a little bit of context of how this legislation and this deduction came into place. And then we'll do all the disclaimers because, as always, these are illustrative and oversimplifications of the legislation. But back in 2017, when they redid the tax code, they came up with something called the Qualified Business Income Deduction, or they call it QBI for short. That's what all accountants will refer to it as. So the way that QBI works is that it allows you, if you have a pass-through entity, so S-Corp, partnership, sole proprietorship, multi-member LLC, you're allowed an up to 20% deduction on whatever your business's profits are. So if you make $100,000 profit, you're allowed an up to $20,000 just sort of bonus deduction on top of that. You make $500,000 profit, you can get an up to $100,000 QBI deduction. So that's awesome. But among the many other caveats that are in there is that at higher income levels, that does start to be phased out, and there are thresholds. And the main threshold that most operating businesses will run into is that it's a threshold of 50% of whatever the wages are from your company. So we've seen scenarios before where people had someone come to us when this legislation first rolled out and their accountant wasn't aware it existed. It was the first year the client had switched to an S corporation. They made a $500,000 profit that year. So they should have been allowed an up to $100,000 or a $100,000 deduction, but the client didn't have any payroll, including for themselves. So because of the fact that their income was so high and the mix of that income being high and the $0 in wages, they got hit with that threshold of, all right, we're going to allow you 50% of your $0 of wages for this deduction. So they could have gotten up to $100,000. In practice, they got $0 for QBI.
Ouch.
So the way that most accountants used to deal with, and some still do because they don't plan properly around this, is that when if you have an S-Corp, you would pay yourself the lowest salary that you could reasonably justify. And the reason behind that is pretty basic, is that the salary is subject to Social Security and Medicare. Whatever you take in distributions are not subject to Social Security and Medicare. So a lot of accountants still got stuck in this viewpoint of anchoring as low as humanly possible to minimize Social Security and Medicare taxes.
Well, and on that, I think that as business owners, this is one thing I really want to drive home, because a lot of us as business owners, especially as we've begun to earn more, we start reading books about taxes and finance, right? And I remember for me, I read this really heavy accounting book, and I got done with that book. You're going to laugh because you're going to look back on our relationship and you know exactly when I read this book. But I read the book and I was like, I think I know something, right? And I started coming to you with strategies and you're like, no, that's changed now. That's phased out. That's no longer the case. Actually, when that was written, there were different tax, different tax brackets, different tax codes. My point being that a fundamental understanding of taxes and the principles behind it as a business owner, as an entrepreneur, I think are important. But the thing we've got to remember is that there are tax laws that are changing all the time, right? All the time. So we don't want to get stuck in our ways or stuck thinking this is a strategy that, that I read about in a book, so it must be right. Go back and look at the date that the book was published, right? Especially
Right.
since 2000, we've seen you've seen it more than me, Micah, just tons of changes to tax laws and tax codes.
Well,
And
I mean, I
so you
think
got to stay up with it.
that's so many things. I mean, when I first started the business, I was big into SEO. I was not an SEO professional, but I was a hobbyist, and I was reading everything on the. I'm trying to remember what the blogs were, but I was deep
Mods.
into it. Moz had been a little bit. I think it was starting to get old at that point,
Yeah.
even. But regardless, I knew quite a lot of SEO about SEO for someone who wasn't a marketer by trade. If I were to try to apply that knowledge now, or if I tried to apply it even a couple years later, completely useless. It's
Yeah.
just the landscape changes so quickly in marketing, and it can change very quickly in tax too, especially these past couple of years as we've had these huge legislative shifts.
Yeah. Well,
So
good illustration. So, yeah, I'd say tax
yeah.
code doesn't change quite as fast as internet marketing, but probably close.
No, no way, no way. Yeah,
So
internet marketing, that seems miserable, just
it
speed
is.
of light all the time. But
Yeah.
but again, just for illustrative purposes, as things do change really quickly, and if you were trying to act as an SEO specialist with your 2010 SEO knowledge, you're getting absolutely clobbered.
Yeah. Yeah. So the point that I wanted to make is if you've read stuff in the past, if you understand some things about taxes, that's great. But just know that there are things like this that we're sharing that have changed just in the past few years, you know.
Right.
So it's
Absolutely.
important to not be like, well, my accountant said this last year. Well, it could have changed since then, you know.
Right.
That's my point.
So many accountants, especially old school accountants, they're still anchoring to the idea of the lowest reasonable salary you can. And even if they're not doing that, they're not planning for QBI. It's they're a couple years from retirement. This was a relatively newfangled thing, and they're not paying attention to it, and that can be hugely to the client's detriment. Because as we'll show, we prepared just a few examples to illustrate this. If you not planning for this properly, especially as your income scales, can be very, very expensive.
Yeah.
So I guess with that, let me do the disclaimers.
Yeah.
I think I did the background
Disclaimer
there,
time.
but just understanding that, again, these are for illustrative purposes only. This doesn't take into consideration other sources of income, which would affect these calculations, especially if you had other sources of W-2 income. They're oversimplifications. I think for everyone, that when I did these scenarios, I had them as single filers. And if you were married, that would change things. It doesn't have dependents. Like, again, these are broad strokes, just rough scenarios to illustrate generally what the concept is and how it can work. But it's not meant to be prescriptive of, oh, you made $200,000 this year, this is the salary you should give yourself, because that's just there's too
Right.
many factors, and that's just not the way tax planning works.
Right. Perfect.
So
You're covered. You're good.
okay, great. So what we did was we took three scenarios. We have one person named Jim who's making $200,000 profit from their business. We did someone named Sharon for $400,000, and then Alex, they made $1.5 million profit in the business. So we're going to kind of run the gamut of how much people could be making. So Jim is making $200,000 in each one of these scenarios. But what we're doing is we're splitting it to, okay, of this $200,000, what's the split we're going to do? How much of it is going to go to his W-2, and how much is going to be taken as distributions and leftover profit?
Just to make it simple, W-2 would be you're paying yourself on payroll. This is subject to Social Security and Medicare, right?
Absolutely.
So,
yes.
yep. If you haven't watched our video on S-Corp flow and how flow-through organizations work, you're going to want to watch that, because if you're wondering where the profit is coming from and what we're talking about there, That's what we're talking about. So those are the two differences here in what Mike is talking about.
Yeah, absolutely. So in column B, this person's taking nothing in W-2. Column C, they took a $50,000 salary. Then in column D, they took a $100,000 salary, but still only making $200,000 in each scenario. So in this case, because the income was lower, in theory, the idea would be taking no salary would be the most tax advantaged thing, because even though the income tax is going down a little bit, if you do a $50,000 salary, you're costing yourself more than that in the Social Security and Medicare taxes. So in pure number standpoint, okay, the QBI optimization doesn't really come into play here because the income is low enough. And if compliance and paying yourself a reasonable salary weren't an issue, you'd pay yourself $0 via W-2. Obviously, that's not compliant with S-Corp regulations, so you can't do that. But for Jim, he would want to pay himself whatever the lowest reasonable salary that he and his accountant determined he could take. So there's no huge tax savings here, because
really good CYA there, by the way.
I mean, I hate having to throw those in there, but there's so many different factors that you've got to take into consideration. And again, I don't want this to be prescriptive of, hey, don't pay yourself anything, it'll save you money.
Salary. Yeah, Micah said, I don't have to take a salary, and I've got an S-Corp.
Right. So for this guy, even though he saves a little bit in federal income tax, it's not saving him on his total tax burden. But if we go over to Sharon, we're going to see that changes. In this scenario, Sharon made $400K profit. Again, every column, she's making the same amount. And we'll see that the sweet spot for her, though, is paying herself a $100,000 salary. Because even though that's generating about $15,000 in Social Security and Medicare taxes, and again, just as another thing, these calculations are oversimplified as well. We just took 15.3%. There's some rough deductions you'd have to factor in as well. But even though it cost her $15,000 in Social Security and Medicare, it saved her nearly $20,000 in her federal income tax. So that this bottom line number, we're seeing that pay that $100,000 salary, she's going to have a total tax burden of about $105,000, versus if she paid herself nothing, then it would be $110,000. So not only is there a net savings of about $5,000, but another important factor is that by doing this, she's paying into Social Security. Right. And at our age, none of us really have confidence that's going to be there when we retire. But all other things being equal, if things were just a wash and there was no actual bottom line dollar figure difference, I'm much happier people paying into Social Security and Medicare, since that's going to or Social Security, since that's going to increase their benefit when they do retire.
Right. Yep.
If we go to Alex, and this is where it's the exact same scenario where we see him paying $200,000, $300,000, $400,000, all the way up to a $600,000 salary. The sweet spot for this person was a $425,000 salary, and that's going to give them a total tax burden of $458,000, versus if they hadn't paid themselves a dime in W-2, which again would be horrible for a bunch of other reasons.
Don't do that.
That total tax burden's going down. Right, don't do that. They ended up accruing a fair bit in Social Security and Medicare taxes, but the total tax burden is over $55,000 less than if they paid themselves nothing.
Yeah.
And we're talking more about not underpaying yourself your salary, because that's more likely what people are to do. But if you overpay your salary, the same thing happens. If you're overpaying your salary, that's decreasing your business's profit, which is decreasing that qualified business income deduction. Because again, qualified business income deduction is up to 20% of your business's profits. So paying yourself a W-2 salary does decrease the bucket that is business profit.
Yeah. And I think what's key here is understanding that there are some basic formulas. Of course, as Have you mentioned that we oversimplified this? You mentioned we oversimplified this.
I think I forgot to, actually, so we should probably go ahead
Disclaimer,
and add that
we've
in.
oversimplified this. But the point is simply that, this is not something that's just pulled out of a hat. And I think that, a lot of times I know with previous accountants that I had worked with, it was like, well, just, you need to pay yourself less, right? Or you need to pay yourself something. And there was really no guidance as to what that is. It's like, okay, well, how much? Well, I don't know. And
Yeah.
you've probably heard that before, right? If you're watching this and you've had that question of like, okay, I've heard that I need to pay myself as little as possible. What does that mean, or how much? The fact of the matter is we are talking about functions of tax planning, right? Tax planning means to me as an entrepreneur, as a business owner, tax planning to me means that I'm not left with for my personal situation, I don't know answers, right? I have a pretty good idea that if I follow these guidelines and these principles and these equations that you guys have in your firm, that I know about what I'm going to be paying in taxes, right? I have a plan moving forward that takes into account things like answering that question. How much should I be making? How much should I be paying myself? What should my salary be? How much should I take from, my flow through profit and things like that? There are formulas, there are equations, there are plans that can be made to find a balance to help you save from, saving taxes by either not paying yourself too little and paying more taxes than what you would need to, or by paying yourself too much and paying more taxes than you need to. It's clear from what we're seeing here that there are formulas and there is a sweet spot.
Yeah, absolutely. And there's just too many things to list of why this can be beneficial. But a pretty obvious one that I don't want to forget is that it can increase the amount that you're going to contribute to your retirement plans, because many retirement plans, the way that they're measured is you're able to do, and if it's based through the business, it's a percentage, it's a employer match as a percentage of the W-2 income that you have from the company. So if you anchor at a really, really low salary, like a SEP, for instance, you can do 25% of the salary you pay yourself. Even a 401k, you've got an employee portion that you can contribute, but the employer match portion is based on that W-2. So there's so many factors to consider, and things are very much dependent on the situation. But this proper planning can not only save you just mathematically a huge amount, but it's also going to be freeing up that cash flow to then be able to contribute more to your retirement plan or reinvest in the business, which also has this compounding effect of decreasing your tax burden and freeing up more cash flow.
Yeah.
So it's one of those things where not every situation we run into is, okay, sweet, we saved you 50 grand, you saved 100 grand by doing this, but the potential is absolutely there. And unfortunately, this is something that a lot of people, like many things related to taxes, either don't know about, don't know how to optimize, or are dealing with accountants who don't do that either.
Sure.
And it's leaving a lot of money on the table.
Well, and if we look at the example here, like just the one that's in front of us, you look at 457,000 and 458,000, right? We see like $1,000 difference in tax savings between those two scenarios. That's $1,000 when you're running a business. It's not the end of the world, right? With what we're talking about here. But the fact of the matter is we're talking about one facet under one very overly simplified scenario in this situation, this tax plan, right? Those thousands quickly add up, right? The thing that gets me is when a friend of mine always used the phrase, being penny wise and pound foolish, where it shocks me when I'll talk to somebody and it's like, hey, how much are you paying for, your existing CPA, and how much do you meet with them? And they're like, oh, I pay, I talked to somebody yesterday. I was like, how much are you paying your CPA and what are they doing for you? and they're like, total, it comes out to $5,000 per year, right? And given they included they had simplified bookkeeping because they didn't have a ton of transactions, they had larger transactions, right? So that was including some bookkeeping. But here's the thing: is paying $1,000 to $3,000 more to work with a CPA who's including tax planning like this. Like, you only have to find like 2 or 3 things like this to make that worth it, right? And the fact of the matter is, from my personal experience, I've seen that there are a lot of little things like this that go into a tax plan. And not only are there a lot of little things, but they change and they shift and they adjust each year. I remember when I had my first child, the accountant that I worked with at the time didn't even know that I had a kid. Didn't include it in the taxes. They just went and filed it without even asking if there was any life changes. Right? Yeah. That's crazy to me. There's all sorts of little things that happen in our life that are changes that need to be taken into account in the tax plan. And those little things, they add up quick, and that's my point is you've got to see that this is just one scenario. And yeah, it's $1,000, but when it comes to tax planning, there's just a lot of things that go into that, that can add up on that.
Oh, absolutely. And the $1,000, that's based on just not hitting quite the proper salary level. That's by paying yourself a little too much. But if you have, we've run into scenarios where, again, there's these old school accountants who weren't paying attention, and they're like, oh, just pay yourself this amount so that you can contribute a little more to your retirement with no other considerations whatsoever. And we've come in and done analysis like this and found tens of thousands of dollars of savings just from QBI playing like this or other things. Like, it's pretty. My favorite part of dealing with a client is the first year we pick them up. Sure. And again, I love building the relationships, and like there's a lot more fun stuff, but it's pretty satisfying being able to look at an old return and be like, nope. Yep. They got that wrong. And we're going to tweak these 1, 2, 3 things. And all of a sudden your tax burden went down close to 6 figures or something like that. There's something it's a very visceral reaction of being able to so quickly find these issues that are small on paper in terms of the tweaks you have to make, but it's free money. It's such a cool feeling of being able to make these very small changes and have this pretty profound effect on the bottom line.
Well, and just to, from the other side of that, from being on the receiving end of that, there's like this feeling of like, oh my goodness, I feel like this burden lifted off, because it's every year, after experiencing that for a few years in a row, you're like, oh man, the business grew. I don't know I wonder what I'm going to be paying in taxes this year, to the first time that weight is lifted. And you're like, oh my goodness, this seems like a reasonable amount to be paying in taxes, right? Like, right. Oh, this is good. That's a huge weight. Now there's a little feeling that goes along with that of like, oh crap, how much did I waste all those other years?
Right. Yeah. You can't, you can, if there's something that can be amended to be fixed, assuming it's just a missed opportunity, which was this, unfortunately, this would fall into that bucket. Yeah, you just can't, because you'll drive yourself nuts.
So it's a mixed bag, but it is amazing to have that weight lifted and to be like, well, this is, I remember the first year that I worked with you guys, my feeling was like, this is a reasonable amount to be paying. This is kind of what I expected, or it's a little bit better than I expected. And it doesn't feel like such a burden. And that's my main point, is that, this is just one element that we're talking about here today. The tax planning is like a symphony. We're right, with all of the different pieces being, in the right order at the right time. And a good CPA is like a conductor.
That's a good way to put it. I've never heard that before, but it really can be.
I really just thought of it on the spot, believe it or not.
That's solid. That's a solid analogy.
It just shows you, even a blind squirrel gets a nut once in a while, So, well, I appreciate this, Micah. And hopefully, if anybody has any questions on this, of course, as always, please drop the comment below. Micah or I will answer that for you, just depending on, if the question is business related, I'll typically jump in and answer that. If it's financial or accounting related, Micah will jump in and answer that. We've got links in the comments below with links to other videos that may help with understanding this, and resources. And of course, if you want to jump on a call with us to get some questions answered about how you can apply this in your business, make sure you grab a call with us there below in the link below. Anything you'd like to add before we jump off here for today, Micah?
No, I think that's perfect. It really just exactly what we've said and what we say on a lot of these videos. There's a lot of things at play here, and just trying to pay attention to all of them, or build a team that does, because if you don't, it can very quickly cost you a lot of money, and a lot more money than you would have paid just hiring the professionals to deal with it for you.
Yep, absolutely. I can attest to that firsthand. Well, thanks again, as always. I appreciate you being here. And for all of our viewers, we certainly look forward to seeing you on next week's episode.